Welcome back to the channel. Today, we're diving into one of the most dynamic and at times unpredictable real estate markets in the United States, Florida. For years, Florida has captured the imagination of homebuyers, retirees, investors, and even global capital. With its year-round sunshine, strong job growth in key metros, and no state income tax, the Sunshine State has long been a magnet for people seeking both lifestyle and opportunity. But here's the critical question. What does the Florida housing market really look like in late 2025? The truth is, Florida is no longer the runaway sellers market we saw during the pandemic boom. Back then, bidding wars were the norm, inventory was razor thin, and buyers were lining up with cash offers far above asking price. Those days are fading. Recent data from trusted sources like the National Association of Realtors, Zillow Research, and Redfin's data center show a clear shift. Inventory is rising, time on market is stretching, and price growth is cooling in several metros. Now, that doesn't mean the Florida dream is over. It means the market is maturing, becoming more balanced. And for many of you watching, this could be the opportunity you've been waiting for. Whether you're a first-time buyer looking for leverage, a homeowner considering selling, or an investor eyeing rental properties or even commercial deals, the playing field has changed. In this video, we're going to break down the latest numbers, visualize the trends, and most importantly, explain what they mean for you. Stick around because understanding these shifts could save you thousands or even make you thousands in your next real estate move. Now that we've set the stage, let's step back and look at the big picture. What exactly happened in Florida's housing market over the past 5 years, and where are we now? To understand today, we have to rewind to 2020. When the pandemic hit, interest rates fell to historic lows, and millions of people began rethinking where they wanted to live. Florida was one of the biggest winners of that migration wave. Families left crowded cities in the Northeast and Midwest. Remote workers looked for sunshine and space, and retirees accelerated their plans to relocate. At the same time, international buyers, particularly from Latin America and Europe, saw Florida as a safe haven for both lifestyle and investment. The result? Prices skyrocketed. According to Zillow Research, the Miami metro saw home values climb more than 60% from early 2020 through 2024. Tampa wasn't far behind, with gains over 40%. Even smaller markets like Cape Coral and Port St. Lucie experienced explosive growth as people looked beyond the traditional hotspots. But here's the catch. That kind of growth is not sustainable forever. By mid-2024, cracks began to show. Mortgage rates climbed above 6.5%, making monthly payments significantly more expensive. Affordability hit a wall, especially for first-time buyers. And by 2025, we began to see the cooling phase. The National Association of Realtors reports that in the broader southern region, which includes Florida, existing home sales flattened out, even as inventory inched higher. That's a major shift from the bidding wars of 2021. Instead of multiple offers within 48 hours, many homes now sit on the market for weeks, sometimes months, before closing. Meanwhile, Redfin's data center tells us that in August 2025, Florida had over 213,000 homes listed for sale, a 5% increase compared to the same month last year. And the median sales price statewide was about $495,000. Yes, that's still high, but the pace of growth has slowed considerably. Put simply, the frenzy is over. What does this mean in practical terms? For buyers, it means breathing room. You don't have to waive inspections or appraisal contingencies just to compete. You have more leverage to negotiate repairs, closing costs, or even price reductions. For sellers, it means strategy is more important than ever. The days of list it and it sells itself are gone. Staging, realistic pricing, and flexibility on terms are now critical to getting a deal done. But perhaps the most important insight here is that Florida isn't just one market. It's a patchwork of very different stories. Miami and South Florida are still in high demand from international capital. But with sky-high prices, many local buyers are priced out. That creates a two-tier market, one driven by wealthy out-of-state or international buyers, and one where locals are struggling. Tampa and Orlando have been magnets for domestic migration, but affordability pressures are forcing some buyers to reconsider. Inventory there is rising faster than in Miami, suggesting more room for negotiation. Jacksonville and the Panhandle offer relatively lower prices and steady growth. These areas haven't been as overheated, which could make them more resilient in the cooling phase. So, the big picture is this. Florida is transitioning from a red-hot, unsustainable boom to a more balanced, segmented market. National headlines might say the market is cooling, but the reality is far more nuanced. Some areas are plateauing, some are slowing, and a few are still showing strength. For you, the key takeaway is this. Don't think of Florida as a monolith. Think of it as multiple micro-markets, each with its own dynamics, opportunities, and risks. Knowing which metro you're playing in is the difference between making a smart move and overpaying. In the next section, we'll dive deeper into supply and demand, looking at how rising inventory and shifting buyer behavior are reshaping the balance of power in Florida real estate. When we talk about whether 2025 is the right year to buy a home, we cannot ignore one of the biggest forces shaping the market: interest rates. They're often called the heartbeat of the housing market because even a small fluctuation can make a dramatic difference in what buyers can afford and how sellers price their homes. Let's start with the basics. Over the past 2 years, mortgage rates in the U.S. climbed to levels we hadn't seen in over 2 decades. This was largely a response to the Federal Reserve's aggressive interest rate hikes designed to tame inflation. In some cases, the average 30-year fixed mortgage rate pushed well above 7%. For many buyers, that meant monthly payments ballooned to the point where they were forced to step back from the market. Now in 2025, we're entering a different phase. Inflation has cooled compared to its peak in 2022 to 2023. And while the Fed is cautious about cutting rates too quickly, we're beginning to see early signs of stabilization. Mortgage rates have edged down slightly from their highs, and experts are debating whether we'll see more significant relief by the end of the year. Here's what that means for affordability. Scenario 1. If rates continue to drop gradually, we may see a surge of pent-up demand return to the market. Buyers who had been sitting on the sidelines could re-enter, increasing competition for homes and potentially driving prices back up. Scenario 2. If rates stay higher for longer, the affordability crisis remains a pressing issue, especially for first-time homebuyers. Even if home prices stabilize, elevated borrowing costs can keep monthly payments painfully high. It's also important to understand that interest rates do not operate in isolation. They interact with home prices and household incomes. Over the past decade, home price growth has significantly outpaced wage growth, creating what many analysts describe as a structural imbalance. Even in regions where home prices plateau, affordability remains strained because incomes simply have not kept up. For example, a median-priced home in many metro areas now requires a household income that far exceeds the local median earnings. This mismatch is why some experts argue that we are unlikely to see a broad-based housing crash. Instead, they predict a slow correction or a regional reshuffling, where high-demand cities stay expensive while smaller or less competitive markets soften. Another dimension here is how higher rates affect investor activity. Institutional investors and private equity firms were major players during the low-rate era, buying large swaths of single-family homes. But as borrowing became more expensive, many of these players slowed down their acquisitions, creating slight breathing room for traditional buyers. However, if rates fall back to the low 6% or even 5% range, investors may re-enter aggressively, once again competing with individuals for limited housing stock. We also can't ignore the psychological factor. Many current homeowners refinanced their mortgages at historically low rates during 2020 and 2021, locking in payments at 3% or below. This creates what economists call the lock-in effect. Homeowners are reluctant to sell and give up their ultra-low rates, which keeps inventory tight. As a result, even when buyer demand slows, supply doesn't increase as much as you'd expect, which helps to support home prices. So, the real question is, what should buyers and sellers expect in 2025? The short answer is uncertainty. Mortgage rates will remain the swing factor that determines affordability, shapes demand, and influences pricing. For buyers, this means flexibility and preparation are crucial. Being pre-approved, understanding the impact of rate changes on your monthly budget, and monitoring Fed signals will be more important than ever. For sellers, realistic pricing and patience may be key, especially in markets where buyers are still cautious. In summary, interest rates are not just numbers on a chart. They directly determine the opportunities and challenges ahead. Whether 2025 becomes a year of renewed accessibility or continued struggle will largely hinge on this single factor and how buyers, sellers, and policymakers respond to it. While national averages often dominate headlines, the housing market in the United States is anything but uniform. What's true for New York or San Francisco may not reflect what's happening in Austin, Phoenix, or small Midwestern towns. In 2025, one of the most fascinating dynamics is how regional trends and demographic changes are reshaping demand, often in ways that challenge old assumptions about where Americans want to live and what kind of homes they want to buy. Let's start with geography. During the pandemic years, many people migrated away from expensive coastal hubs to more affordable regions in the South and Midwest. Cities like Austin, Nashville, Tampa, and Raleigh saw population booms fueled by remote work flexibility, lower taxes, and relatively cheaper housing. This migration wave led to soaring prices in those markets, sometimes outpacing even San Francisco or Los Angeles in percentage growth. Fast forward to 2025, and we're seeing two things happen simultaneously. First, some of those pandemic boomtowns are cooling off. For example, home prices in Austin or Boise that skyrocketed between 2020 and 2022 have leveled out or even declined slightly as affordability was stretched too far. Second, there's a stabilization trend in many secondary and tertiary markets, where growth is still happening but at a more sustainable pace. Buyers who missed the first wave of relocation are now being more selective, considering factors like job growth, infrastructure, and community development instead of just price. Another key trend is the resurgence of urban living. For a while, big cities seem to be losing their appeal, with headlines about residents fleeing New York or Los Angeles. But in 2025, urban centers are regaining momentum. Why? Because remote work is no longer the universal standard it was in 2021. Many companies are requiring hybrid or full-time office returns, and that brings professionals back to city cores. While affordability challenges remain in these metros, rental markets are booming, and buyer demand is creeping back as younger professionals see long-term opportunities in urban real estate. On the flip side, suburban and exurban areas are not losing steam. Families still prioritize space, safety, and good schools, and suburban homes continue to deliver that. What's evolving, however, is the rise of commutable exurbs. These are outer ring communities that once seemed too far from major job centers, but are now viable thanks to hybrid work. Living 90 minutes away from a city no longer feels unreasonable if you only need to commute twice a week. This has created new demand pockets in places once overlooked by both builders and buyers. Now let's talk demographics. Millennials, the largest living generation in the U.S., are still a driving force in the housing market. Many are in their 30s and 40s, prime home buying years, and they continue to fuel demand despite affordability challenges. However, Gen Z is beginning to emerge as a factor. While most are still early in their careers, their attitudes toward homeownership are more cautious than previous generations. Surveys suggest Gen Z values flexibility and experiences, meaning they may prioritize renting or co-living arrangements longer than millennials did. That could slow the pace of first-time homebuyer activity in the coming decade. At the same time, baby boomers are shaping supply dynamics. Many are choosing to age in place rather than downsize, which keeps inventory tight. Others are downsizing, but not necessarily moving into traditional retirement communities. Instead, they're seeking smaller single-family homes or condos in walkable neighborhoods. This creates competition with younger buyers for the same kinds of properties, further straining the supply of affordable starter homes. Regional affordability gaps are also widening. In the Midwest, cities like Cleveland, Detroit, and St. Louis still offer homes at prices considered a bargain compared to national averages. But job opportunities and population growth lag behind, making these markets slower to appreciate. Meanwhile, in the South and Southwest, migration continues to drive demand, even as rising insurance costs, climate risks, and infrastructure strains create new challenges. For example, Florida remains a hotspot for buyers from the Northeast and Midwest, but the cost of homeowners insurance and exposure to hurricanes are weighing heavily on affordability calculations. Climate change is another factor reshaping regional demand. Wildfires in California, flooding in the Gulf Coast, and extreme heat in Arizona are forcing both buyers and insurers to rethink where long-term investments make sense. Some experts believe climate risk will increasingly divide the housing market, with climate-resilient regions attracting more demand and commanding premium prices, while high-risk areas face stagnation or decline. In summary, regional and demographic shifts remind us that the U.S. housing market is not a single story, but a patchwork of diverse narratives. From millennials pushing into the market, to Gen Z rewriting expectations, to retirees competing for smaller homes, the forces of demand are multi-layered. Add in regional migration, climate risk, and the evolving nature of work, and the result is a highly dynamic housing landscape. For buyers, the lesson is to look beyond national averages and study local conditions carefully. For sellers, understanding who your likely buyer is, whether it's a millennial family, a downsizing boomer, or a relocating professional, can make all the difference in pricing and marketing strategy. When analyzing the U.S. housing market in 2025, one truth stands out. This is a period of both significant risk and immense opportunity. For buyers, sellers, and investors alike, understanding how to navigate this landscape is key to making smart decisions. Let's break down the main risks first, and then explore where the opportunities lie, before distilling all of this into some strategic advice you can actually use. Key risks in 2025. The most obvious risk is affordability pressure. Mortgage rates, while off their 2023 highs, remain elevated compared to the ultra-low levels we saw in the 2010s. According to NAR data, the average 30-year fixed mortgage in 2025 still hovers between 6% and 7%, which significantly reduces purchasing power. Combine that with persistently high home prices, and many households find themselves priced out. Another major risk is economic uncertainty. While unemployment remains relatively low, concerns about inflation, wage growth, and potential Fed policy shifts hang over the market. If the economy slows, housing demand could weaken, leaving overextended buyers in a difficult position. Then there's the insurance crisis in climate-sensitive regions. States like Florida and California are experiencing skyrocketing homeowners' insurance premiums, in some cases doubling within just 2 years. In extreme scenarios, certain insurers are pulling out of markets altogether, leaving homeowners with limited and expensive options. This risk not only threatens affordability, but also erodes long-term confidence in markets vulnerable to natural disasters. Finally, the supply shortage remains a structural risk. Builders are constructing fewer entry-level homes than in past decades, focusing instead on higher-margin properties. Combined with baby boomers holding onto their homes longer, this keeps inventory levels chronically tight, which can fuel bidding wars even in a supposedly cooling market. Where the opportunities are. On the flip side, opportunities exist, especially for those willing to think strategically. First, let's talk about buyers. If you're financially stable, now may be a window of opportunity. While affordability is stretched, competition has eased compared to the frenzy of 2021 to 2022. Redfin data shows that fewer homes are receiving multiple offers above asking price. Buyers today have more leverage to negotiate contingencies, inspections, and even seller credits to offset closing costs. For investors, rental markets remain strong. High mortgage rates keep many households from buying, which sustains robust demand for rentals. Markets like Atlanta, Phoenix, and parts of the Midwest are seeing steady rental growth, offering investors a chance to generate stable cash flow. Additionally, build-to-rent communities are expanding, providing new models for institutional and individual investors alike. For sellers, timing and strategy are critical. If your home is well-maintained, priced correctly, and located in a desirable neighborhood, it will likely still attract strong demand. However, overpricing is dangerous in today's environment. Buyers are more cautious and informed than ever, with instant access to market data from Zillow, Redfin, and other platforms. Sellers who adapt their expectations to the current climate and who market effectively can still succeed. Finally, for long-term investors, opportunities exist in regions poised for demographic growth. The Southeast continues to attract migrants due to job creation, lower taxes, and relatively lower costs of living. Meanwhile, the Midwest presents value plays. Lower home prices coupled with growing interest from remote workers and companies relocating from high-cost states. Strategic advice for 2025. So how should you approach this market? For buyers, the strategy is to stay realistic and focus on fundamentals. Don't stretch your budget to chase a dream home that puts you at financial risk. Instead, prioritize affordability, location, and long-term livability. If mortgage rates drop in the coming years, you can always refinance, but you can't change a bad location. For sellers, the key is flexibility. Be prepared to negotiate and consider sweetening the deal with incentives like covering closing costs or offering mortgage buydowns. Presentation also matters more than ever. In a slower market, professional staging, quality photography, and online visibility can make a huge difference in attracting offers. For investors, diversification is essential. Don't put all your resources into one market or property type. Consider spreading investments across residential rentals, multifamily, or even select commercial opportunities if your risk tolerance allows. And always factor climate risk into your calculations. Buying in a flood zone without proper insurance could be catastrophic in the long run. In essence, the U.S. housing market in 2025 is a market of contrasts. The risks are real, but so are the opportunities. The winners will be those who stay informed, remain adaptable, and think long-term instead of chasing short-term speculation. As we wrap up this deep dive into the U.S. housing market of 2025, one theme becomes crystal clear. This is a market defined by complexity, contrasts, and constant change. On the surface, headlines may highlight affordability struggles, elevated mortgage rates, and tight inventory. Yet beneath those challenges lies a wealth of nuance. And for those who pay attention, a roadmap for smarter decisions. Let's recap. From the data provided by NAR, we know that sales volumes remain below pre-pandemic highs, but inventory is finally showing signs of recovery. Zillow's Home Value Index reveals that home prices continue to inch upward, albeit at a slower pace than the explosive growth of 2020 to 2022. Meanwhile, Redfin's real-time metrics tell us that bidding wars have cooled, giving buyers more negotiating power. Each source paints a slightly different picture, but together they form a mosaic, a market that is neither crashing nor booming, but recalibrating. The risks are undeniable. Elevated borrowing costs limit what households can afford. Climate change is introducing new layers of uncertainty, particularly in states like Florida and California. And demographic pressures, such as baby boomers aging in place and millennials competing for starter homes, keep supply and demand out of balance. But the opportunities are just as compelling. For buyers, this is a chance to enter the market with more leverage than in recent years. For investors, rental demand remains strong, and certain regions still offer attractive entry points. For sellers, well-prepared homes in desirable locations are commanding solid offers, provided pricing is realistic. So what's the ultimate takeaway? The U.S. housing market in 2025 is no longer a one-size-fits-all narrative. Success depends on zooming in, studying local trends, and aligning decisions with personal goals and risk tolerance. A home in Cleveland is not the same as a home in Miami. An investment property in Phoenix will perform differently than one in Chicago. The key is to match strategy to circumstance. For anyone considering a move, whether buying, selling, or investing, here's some expert advice to remember. Stay data-driven. Leverage resources like NAR, Zillow, Redfin, CoStar, and FHFA. Each offers unique insights that, when combined, give a fuller picture of the market. Think long-term. Don't get caught up in short-term price fluctuations. Real estate has always rewarded patience, especially when purchased in the right location. Budget realistically. Factor in not just mortgage payments, but also taxes, insurance, and maintenance costs, all of which are rising in many markets. Adapt to risk. Climate change, economic shifts, and demographic transitions are not abstract issues. They directly affect property values and livability. Seek professional guidance. A trusted local agent or financial advisor can help translate national trends into actionable local strategies. In closing, the market of 2025 is best described as a reset. After years of volatility, buyers and sellers are adjusting to a new normal. It's neither the overheated frenzy of the pandemic years nor the doomsday crash some predicted. Instead, it's a market that rewards those who are informed, cautious, and strategic. And that's the real story. Real estate is less about timing the market and more about time in the market. If you align your decisions with solid data, personal goals, and long-term thinking, 2025 could be the year that sets the foundation for lasting success.